I just want to thank everyone. Reminder to everyone, put their phones or tablets on mute. That'd be great. At AIAC, we've been very much trying to engage with the membership through webinars such as this. We just had one on Monday with our Aerospace caucus, so a group of members of parliament from each major party came on. And we had a great discussion with Mr. Schrey. So if you did miss that, we are going to be putting that out as a podcast, and I would encourage folks to take a listen to that also. Stay tuned through the fall. We are going to be doing more webinars, again, connecting the membership, trying to get out topics of interest such as this. We had a great Canada Emergency Wage Subsidy webinar earlier in the spring. And Ernst Young have been absolutely great partners throughout COVID-19, helping get out information and trying to synthesize what can be, I think people can agree, sometimes confusing programs that are out there. And I think I know we've gotten a lot of feedback on the wage subsidy piece, the 2.0 that has just come into effect. So we're very pleased to have Ernst Young here and David to try and you will explain it. We'll try and understand it together. So that's great. So maybe I'll pass it over to, I don't know, Krista, if you wanted to say a few words before passing over to David, but thanks again to Ernst Young. We will make this available. And if there's any questions, please email myself, put it in the chat function. And if you'd like to have a follow-up discussion with David or the Ernst Young's team on your specific situation, I'm sure they'd be happy to do that. So maybe Krista, I'll turn it over to you, and then over to you, David. Thank you again.
Perfect. Thanks, Mike. Can you hear me okay?
We can hear you.
Good. Okay, good, because it was looking like I was still on mute. I'll just mention that David is actually overseeing the CEWS program across the country for us. So he's our national leader in that regard. So hopefully David can make what seemed to be quite complicated rule set, but advantageous rule set seem less complicated by the time we're done. So don't be shy about asking questions, because it's been quite a road for everybody to learn this second, what we call CEWS 2.0. And you'll hear David refer to that in the presentation. So the CEWS adjustments July onward is CEWS 2.0. And hopefully we demystify it a bit so you can see the benefits of it. So I will stop talking there and pass it over to you, David. Nice to see you.
Great. Thank you very much. I'm glad that we got the technical difficulties dealt with.
Yeah, exactly.
And thank you for everyone for attending the webinar today. What we're going to take you through in this presentation is we're going to start by going through what are the key changes between the CEWS program, or the CEWS program as it was initially proposed back in, and if you remember, it was proposed in early April. And I just want to once again emphasize, if you look at how quickly things have moved and changed, well, March may seem like it's a distant memory in the past. If you put it into perspective, we haven't been more than 6 months into this at this point in time, and we've seen a number of changes in this program. So we've really broken the presentation into two components. The first one is the key changes from CEWS 1.0 to CEWS 2.0. And then once we get through that, I'm going to take a bit of a break just to see if there's specific questions with respect to how CEWS 2.0 will operate, and then switch over. And I also want to just highlight some of the technical changes that have been made to the program to make it more accessible for more individuals, and to deal with some technical, or companies and businesses, to make it and take care of some technical issues. So we'll talk about the additional eligible entities that have been included, how they've dealt with now the problem that was arising from amalgamations and business purchases, asset purchases as well, that were throwing people offside the program, which it wasn't intended to exclude. And we'll also talk about some of the issues we're seeing on paymaster arrangements as well. So let's jump into it. Before we get into the changes itself, I want to highlight where we're at from a statistical perspective and try to understand why the government changed CEWS from the 75% wage subsidy to what it is now, which is a wage subsidy based on how your business is performing, essentially. And I think these statistics really highlight what the government was attempting to do in making these announcements in late June and early July with respect to the change of the program. And remember, what I want to compare and contrast here is the two main programs that they're providing to support workers during the pandemic. The first one, of course, is the Canada Emergency Wage Subsidy, which is the wage subsidy being provided to employers to encourage employers to retain their employees on payroll during this period of time. The second is the Canada Emergency Response Benefit. That is or was the $2,000 a month, or more technically $500 a week, that the government was providing to workers who had been impacted and lost work as a consequence of CEWS. And effectively, the CERB replaced the employment insurance system during this period of time. The other part to recognize with CERB is that it applied not just to employees, but to all workers. So it meant that independent contractors, those individuals who are those people in the gig economy who are treated as independent contractors, but the Uber drivers, the Uber Eats people, those group, that they had support during this period of time, even though they wouldn't have been able to access the unemployment insurance system. Now, if you look at those numbers, though, and I think this is where the government said we need to change and realign the Canada Emergency Wage Subsidy. And in particular, look at the number of unique applicants and look at the number of workers that are being supported under the Canada Emergency Wage Subsidy program. Roughly 3 million have been supported under the wage subsidy program, but look at the number of unique applicants for the Canada Emergency Response Benefit. There's 8.6 million people who have accessed and benefited from that program. What the government's attempting to do as economies are reopening, as the provinces, as we've moved to stage 3 in Ontario or across the country as businesses have come back, gyms have started to reopen, restaurants are now permitted to have indoor eating, etc. Recognized not at full capacity. What the government's attempting to do is they're hoping to see that CERB number drop significantly, and they're attempting to address this. If you look at the number of people who are being supported under the wage programs, we've got essentially 12 million Canadians that are somehow, there is government assistance with respect to the wages and salaries and remuneration and their day-to-day living costs that are being supported under these programs. If we look at the employment gap that got created when this pandemic started, Canada's total workforce hovers around 19 million employed people. Now, I want to emphasize that's employed. We're not including the independent contractors in this stat. But as you can see, we lost 3 million in employment when the pandemic started. So between March and April is that significant gap. And when they modified the CEWS program at the beginning of June, we had just received unemployment numbers or employment figures out. And while we are seeing a rebound, there's still, of the 3 million who were essentially laid off and lost work at the start of the program, we're now back. We still have 1.2 of them, or 1.2 plus of them have found employment or are back being employed, but we still, at least at the beginning of the summer, had a 1.8 million gap in the number of people who were employed before the pandemic started. And so if you look at the modifications from CEWS 1.0 to CEWS 2.0, what the government is effectively trying to do is to try and encourage businesses and employers to bring those people back, to bring them back onto payroll so that we can get the economy started and rolling again. So what are the key changes that were brought in? So the first thing is the government announced that they are adding yet another 3 periods. Remember when it was first brought out, and all of the periods are exactly 28-day periods. They are 4-week periods. So initially, the program was designed to last for only 12 weeks. And then in April, it was announced that it was going to be extended for another 3 weeks to the end of the summer, or 3 periods to the end of the summer to August 29th. And then the government announced with CEWS 2.0 that the program would be now extended for a total of 9 periods, ending currently on November 21st, but with the possibility of it being extended for at least one more period on the basis of the legislation that's now been enacted. The second thing is they've attempted to address the concerns that businesses were expressing under the old program. And if you look at the challenge with CEWS 1.0 and what they've done in CEWS 2.0, CEWS 1.0 was a very generous wage program. It was the wage subsidy is 75% of the eligible remuneration, up to $847 per week per employee. But in order to qualify, you had to have a revenue drop in a year-over-year comparison, or alternatively comparing to your average of January, February of 2020, you had to have at least a 30% drop in your arm's length revenue, your qualifying revenue as it's defined. The challenge with that was that it meant that a business that was down 33, 34%, but was still operating during this period, compared to the neighborhood gym or the restaurant, etc., which had seen its revenues drop by 70 or 80%, were receiving the exact same amount of subsidy, that subsidy of 75% of wage subsidies. What it also meant, however, is that if you were down 31% in the particular comparison, March to March, April to April, May to May, if you qualified under the program and you were down, you'd met the threshold, but just barely. So in March, it had to be down 15%. April and May, June, it had to be down 30%. If you were at 31%, suddenly that's a windfall for you. You qualify for a 75% wage subsidy. But if your competitor in the exact same industry was down 29%, what that resulted in is your competitor got absolutely nothing. And if you look at the value of the claims of this program, we've been working with a number of people who are eligible for this program, where the amounts aren't just in the millions, they're in the tens of millions, in some examples in the hundreds of millions of dollars for this program. And so for CEWS 2.0, what the government did instead is they said, we're going to modify the program. And instead of having an all or nothing rule, now anyone who's experienced a revenue reduction, you no longer have to meet the 30% test. Anyone who's experienced a revenue reduction in the remaining periods is going to qualify for a wage subsidy based on your revenue reduction percentage. What percentage is your revenue down? So what that then amounted to is the additional key changes to this is that they moved the deadline for filing. That used to be that you had to have filed by September 30th. With the extension of the program, they've now moved that to January 31st, 2021 as your drop dead date for applying. They also had to deal with, if you recall, under CEWS 1.0, there was a rule that said that if you experienced the requisite revenue drop in one period, you were automatically deemed to qualify for the next period. Now, if you think of what that meant, is it meant that as long as you qualified for one period, you knew that you were in the program for at least 8 weeks. So you got the 4 weeks that you qualified for and were deemed to be in the next. That's no longer relevant in terms of if you are experiencing a revenue reduction in comparing year over year, you automatically qualify. So what they've done is they've replaced that deeming rule with a minimum revenue reduction percentage rule. And what that essentially is very simply put, if in the current period, your revenues are down 15% compared to the prior year, or if you've elected to choose the alternative method of January, February of 2020, if you're down 15% in July, by way of example, then for August, 15% is the minimum amount you'll be down. You'll be at 15%, your revenue reduction percentage will be at least 15%. And if August you're actually down 10%, well, then your revenue reduction is deemed to be the 15% from July. If things have gone the opposite direction and you're at 20%, then for August, your revenue reduction percentage is down 20%, which means for September, you've set that minimum threshold for the next period. The concept of baseline remuneration for periods 5 through 8, you'll recall that there was a concept that you had to know what was the average weekly remuneration that you pay to each of your employees from January 1st, 2020 to March 15th, 2020 under CEWS 1.0. That has been completely eliminated at least for all employees other than employees who deal with the employer at non-arm's length. So the example of that is, think of your neighborhood restaurant. The family that owns the restaurant, they still have to be considered what their baseline remuneration is, but the concept of baseline remuneration for every other, for arm's length employees, is no longer applicable for periods 5 through 8. There's also a safe harbor rule. So they recognize that there are going to be some taxpayers who, if you think of what's happened, you've gone from March, April, May, and June, and your wage subsidy was 75%. Then in July, the wage subsidy under CEWS 2.0 is going to be based on what your revenue reduction actually is, which means if you were down 32%, that your wage subsidy under the new program is based on that 32%. In other words, if we just left it at that, you would see your revenue, your wage subsidy drop from 75% down to, it'll be a different number than 32%, but a number based on 32%, and we'll get into explaining that. So what they did is they said, for July and August, we acknowledge that businesses are still reopening. If you have still experienced in July and August, your revenue reduction percentage is 30% or greater, then effectively you will still qualify at least for the 75% wage subsidy under CEWS 1.0, at least for periods 5 and for potentially period 6. Finally, the last major change is that concept of who's an eligible employee. If you recall, under CEWS 1.0, an eligible employee included employees who were without remuneration for 14 or more consecutive days. So there was the whole issue of you had laid people off. You had to bring them back before the 14-day period expired if you're going to claim in respect of their subsidy. And the concept there was that what they were trying to do is say, well, if the worker is being supported through the wage subsidy program, they shouldn't be entitled to the CERB, keeping in mind that CERB, to qualify, you had to be without remuneration for 14 days during a period. That's been eliminated for periods 5 through 9 of CEWS 2.0. So once again, just let's look at some of the basics of CEWS 1.0 so we can look specifically at the comparison to CEWS 2.0. Remember, as I've said, you had to have at least a 30% drop in qualifying revenue, and that was in comparison to the same calendar month, and I want to emphasize calendar month. You can't be on a 445 accounting basis. It has to be on your calendar month of the prior year or compared to January, February of 2020. And what you were entitled to is a 75% wage subsidy to a maximum of $847 a week. Now, I've put on the slide here that you see that 75% of the number $1,129 is equal to $847. That's important because now the wage subsidy in your maximum amount is based on that $1,129. That represents the eligible remuneration upon which the wage subsidy will be paid. There was no limit on the total subsidy that an employer was entitled to. And from the employee's perspective, keep in mind that the wage subsidy was more generous than CERB because on an after-tax basis, the employee received roughly $650 to $680 a week after tax, depending on the jurisdiction they were in. Then keep in mind that under the old program, there was the rule that said that if you had employees who you were on their payroll, but they were furloughed, they have no work whatsoever, but you've kept them on the payroll, there was the added incentive for you to keep them on payroll in that the government would also get subsidized or give you back essentially an amount equivalent to your CPP and EI contributions, the employer's contributions to them. CEWS 2.0, as I mentioned, is now an extension. We have 5 new periods. Any drop in qualifying revenue qualifies you for a wage subsidy. As little as a 1% drop in year-over-year qualifying revenue, and you're entitled to a wage subsidy. So when under the old program, the whole issue was, have I exceeded the 30%? Great, I'm going to go claim my 75%. Now what you can see is that If you've experienced a drop, you're going to actually now have to go through the whole issue, all of the questions we were dealing with before about what constitutes qualifying revenue, what should be included. Is it based on your gross revenue, your net revenue? Can you rely on your estimated revenue in your monthly financial statements, or do you have to true up to include the quarter end adjustments that you normally do when you do hard closes for your financial statements? All of those issues under CEWS 1.0 only became truly material and relevant if you were close to that 30% threshold. Now it becomes completely relevant because depending on what your number comes out to be, that's going to determine the quantum of your wage subsidy to which you're entitled. So a couple of key terms that I want you to take away from this slide, I want you to note in particular, your revenue reduction percentage will turn into your base percentage. So your revenue reduction percentage is what you actually calculate as being, what you determine based on looking at the same calendar month in 2019 to the same calendar month in 2020. You do the comparison, and that reduction represents your revenue reduction percentage. That then gets converted into your base percentage, and I'll explain that in just a moment. And then there is an additional amount for those employers who have experienced a revenue reduction of greater than 30% in the prior quarter leading up to the particular month. If it's greater than 50%, you may be entitled to a top-up. So there's also two concepts to come up with what your rate of your subsidy is. You take your revenue reduction percentage, you modify it, as I'll explain in a moment, to come up with your base percentage. And then you have a completely separate question of, do I qualify for a top-up? And then I take the top-up percentage and the base percentage and add them together, and that will determine the CEWS, that will determine the percentage of wage subsidy, or your wage subsidy percentage that you're entitled to claim. So if we break the periods down per se, what we've put on this slide is each of the periods is specified. Then we've put in what is the calendar month that we look to determine what our revenue reduction percentage and our base percentage. And then we turn and we look at what is our prior reference period, you can compare to either March 2019 or to an average of January, February of 2020. And then you look at what's your qualifying revenue threshold. And what this highlights in this table is that your qualifying revenue threshold was only relevant for CEWS 1.0. It's not relevant for 2.0. Now, there's a hard line between CEWS 1.0 and CEWS 2.0. One of the things that the government addressed is that, remember, you had the option with respect to your prior reference period. You had the choice of saying, and the example that was used was turning and saying, if my business was in startup mode back in February and March of 2019, and I then got a year of operations in place. So I opened my gym in February of last year. I was just getting my memberships going and the rest of it. I started to have some success, and then you shut me in March of this year. That's not a valid comparison because I don't have much qualifying revenue during my startup phase. And so they allowed you to elect to choose your prior reference period as being a comparison to Jan and February of this year, or the average of that revenue. What they've allowed you to do under CEWS 2.0 is that if you've made that election to use the prior reference period as being January and February of 2020, for CEWS 1.0, you're at a reset amount. You can reset that election. So for the balance of the program, you can choose once again as to whether you're going to continue to use the average of January and February as your prior reference period, or alternatively, you can revert back to doing the year-over-year comparison. So you can hear how the modeling is going to be necessary for you to figure out, well, which is most advantageous for me. Once again, though, if you do elect to use January, February as your current reference period, you can't make that election on a period by period basis. You make it on it's either, if you made it for CEWS 1.0, it's for all 4 periods in CEWS 1.0. And if you choose to make it for CEWS 2.0, it has to be used as your prior reference for all of CEWS 2.0. So let's look at those 2 components. So let's start with looking at coming up with your base percentage. The base percentage is for employees, those 2 components is your base percentage is for any employer with a qualifying revenue drop of 50% or less, and you're comparing to the current qualifying period to the prior year's qualifying, to the qualifying reference period. So keep in mind, for the base percentage, you're doing a month-to-month comparison. Then you have to then consider, am I eligible for a top-up? And this is a top-up that you're eligible for if you still experience a significant drop in your qualifying revenue of more than 50%, but your comparison is no longer current month to prior year month. What you're looking at instead is a quarterly average based on the prior 3 months to the current period, to the prior 3 months, the average of the prior 3 months in 2019, to come up with that comparison. So now you're just not doing a month-to-month comparison, but if you're looking at the top-up percentage, you have to look at, well, what was my quarterly drop for the 3 months leading in? So if we look at this in terms of determining your base percentage, what the government did was turn and say, start with your revenue reduction percentage. So for July, August, for each of the remaining periods, the reference period you're looking at is July, August, September, October, and November to determine if you qualify. And then you note that your revenue reduction percentage, the actual number that you calculate based on your own financials, isn't the amount that you claim as the subsidy. Because what they've done in the balance with you take that revenue reduction percentage that you've calculated, and they've turned and said, during the summer months of 2020, we want to provide additional wage support because we recognize the economy is only starting to come back. For September and the balance of the fall, we want to wean employers off of this. So what they do is they've turned and said, take your revenue reduction percentage. So if you're down, and I'll use the example of 20% in the month of July, we're going to take your revenue reduction percentage, 20%, and we're going to multiply it. We're going to increase it by multiplying by 1.2. So in my example, your base percentage, your revenue reduction percentage was 20%. Your base percentage is 24%. So that would be the quantum, that would be the base percentage that would form part of the amount determining that you're entitled to at least a 24% wage subsidy with respect to your employees' eligible remuneration during the month of July. They've done the same thing in August, and then look at what they've done in terms of that multiplier. In September, they're turning and saying, well, now we want to start weaning you off of it. So for September, take your revenue reduction percentage and just multiply by 1. So there's not going to be grossed up. And then note what happens in October and November. You suddenly see them turn and say, we're now going to reduce your revenue reduction percentage. In September, for October, in your comparison, you only get 80% of your actual revenue reduction percentage. And then in November, it's down to 40%. So you can see how it decreases over the course of the fall. As I mentioned earlier, under CEWS 1.0, we had that entire concept of saying, if you qualified for one period, you're deemed to qualify for the subsequent period. What you see on this slide is with respect to CEWS 2.0, periods 5 through 9, is that in order to determine your revenue reduction percentage, you've got a deemed minimum, and you look back to the prior period. So if we look at period 5 by way of example on the slide, right in the middle, if you determine that your revenue reduction in the month of July, you're down 15%, but in June of 2020, you were down 20%, then your revenue reduction for the month of July is deemed to be the greater or lesser, depending on your perspective. It's going to be the 20%, not the actual 15%. But then the 15% in July is going to create that minimum amount for what your revenue reduction percentage would be for the month of August. Now, that's determining your base percentage. Then, as I mentioned, you now have to consider, now how do I determine whether I'm entitled to this top up? Well, the top up, the key distinctions are that what you're going to compare instead is not month to month, but what you're going to look at and what the threshold you want to meet is you want to figure out whether, on average, in the 3 months prior to the beginning of the qualifying period, in those 3 months leading up to the period that I'm looking at, if I compare the average qualifying revenue in those 3 months in 2020 to the average of those qualifying revenue amounts in 2019, or you can once again elect to use the average of January and February of 2020. But when you do the comparison on that 3 month, that quarterly basis, are you down more than 50%? And if you are, you're going to qualify for the top up. And with the top up, right through the entire program, they take the amount that you're down above 50% and they once again gross it up by an additional 25% by multiplying by the 1.25, pardon me. Now, you might say, well, we reopened in July, so we're not going to qualify for this because things have really come back. But look at what the top up actually does. It's looking at, if we look at July as an example, it's saying, well, take your average revenues in April, May, and June, determine what your monthly average qualifying revenues were in 2020, and compare them to April, May, and June of 2019. Now consider the following. Well, if your business was shut in March and you had very little qualifying revenue in April and May and only started to reopen in June, you may actually qualify and be able to say, well, yeah, our revenues were down for that 3 month period more than 50%. So I qualify for the top up, even though in the month of July, we've reopened and now we're only down 20% or 10% as the case may be. How do you then take, so as I said, in order to determine, how do you determine how much you're going to be entitled to? Well, you take your revenue reduction percentage for the particular month, multiply by that gross up clause, the 1.2 or the 1 or the 0.8 or 0.4, depending on the period. And then you add whatever you're entitled to as the top up percentage. And those two figures, those two percentages combined becomes the percentage of the wage subsidy to which you're entitled to. So then you take the eligible remuneration for each individual employee once you've determined what your percentage rate is, and you multiply the percentage that you've obtained by either the actual weekly eligible remuneration that you've paid to the employee. If the weekly remuneration that you actually paid exceeds $1,129, then you're capped at that amount. Or if you do have non-arm's length employees, those non-arm's length employees, you still have to consider their baseline remuneration. Now, so what that effectively means is now your revenue reduction percentage combined with what is my top-up percentage becomes the amount of the wage subsidy you're entitled to. Subject to, for periods 5 and 6, July and August, is where the government turned and said, we recognize that we will have businesses that are down more than 30% in July. Their revenue reduction percentage is 30% or more in July and 30% more in August. And under the old program, you would have been entitled to a 75% wage subsidy program. And now under the program, you would only be entitled to, if you're at 31%, a wage subsidy based on the revenue reduction percentage of 31%. So what they did is they created a safe harbor rule for those two periods, for period 5 and 6, which essentially when you work through the formula says, if you're down 30% or more in July. Your revenue reduction percentage is down is 30% or more in July or 30% more in August, then effectively you'll still be entitled to, at a minimum, the 75% wage subsidy that you were entitled to under CEWS 1.0 for those 2 periods. That does not apply for September, October, and November. Now, if you have employees that are on leave, that are on your payroll but on leave, so the furloughed employees, there's a couple of criteria here just to be very clear. You have to be able to establish, before you're entitled to anything with respect to their remuneration, you have to establish that for the current period that your revenue reduction percentage is that you have an actual lot, you're still down either in the actual month or using the top-up comparison to the average of January of the 3 months ending prior to the period. So you have to be able to point to one of those 2 numbers and say it's a negative amount. I'm down, I've got a revenue reduction at either on a quarterly basis, the prior quarter basis, or the 3-month basis, or in the current month. If you've met that test, then what you actually get for those employees who are on your payroll but on leave, they're performing absolutely no work whatsoever. I think the example that I used previously, which is readily available, is the airlines, to the extent that they have flight crew that they are not using, that they're still on payroll, and that they're still receiving payments, but they are not actually performing any work whatsoever. Then in this circumstance, the government's turned and said, well, in order to give you the encouragement to keep them on the payroll, because it wouldn't make sense if you're turning and saying, well, now you're taking now I'm down only 20%, but I'm not, I might as well get rid of them. They're costing me too much. The government's turned and said, no, we'll still give you a wage subsidy of up to their actual remuneration paid in that week, or 75% of the actual remuneration, whichever is the least of those 2. So in other words, the program hasn't really changed for CEWS 2.0 for those employees who are on your payroll but have been furloughed. In addition, they've kept the same thing from CEWS 1.0, which is you're still entitled to receive back in respect of their remuneration, the employer's contribution to CPP and EI. So before I go on from there, I'm going to just stop and see if there's any particular questions with respect to the program and the distinction between CEWS 1.0 and CEWS 2.0. And see if there's any particular questions that have come in. Just before I take the questions, a couple of things you note, what this is going to, the program and how the balance of the program's changed. The conversations we were having with clients previously was under CEWS 1.0 was, have I actually crossed that 30% threshold? Now they've vastly extended the program to a much wider group of businesses. All you have to do is show that you've got a revenue reduction percentage. So now all of the questions that we were dealing with a smaller group of clients and sitting down and saying, as I say, what do you do with the quarter end adjustments and your IFRS adjustments? What do I do with the, what do I do with foreign exchange? How do I treat dividends and interest? Are they included? If I've got a partnership in the group, what am I doing with the proportionate? Does it matter whether it's on I consolidate on a proportionate or an equity basis? All of those questions that we're dealing with that limited group who was trying to figure out, did I meet the 30% threshold or not? Now, all of those questions become relevant for anyone is claiming the CEWS, because you need to determine what is the accurate number. What is my revenue reduction percentage for the period? And in terms of that, like, I have to give my hats off to this. This has been interesting for me, for someone who mainly does tax litigation and advises on transaction taxes for most of my career. Is it's given me an opportunity to meet a number of groups across EY. So our FAS teams, our financial account reporting teams, have been fantastic at lending support for us being able to advise clients and to work through some of those particular matters. Shannon O'Mahony and her group in particular have really stepped up and educated me on sort of the distinction between what you think from a tax perspective versus what you think from an accounting perspective. I think in particular with partnerships, with the distinction between joint operations versus joint ventures, those words mean something very different to a tax person than they do to an accountant, and the impact that can have on your CEWS claims as well. So I'm pausing. I pause and say, don't just go into it and think that, well, I'm just going to do this simple calculation. There are adjustments, and you can see that the audit risk that's going to be associated around that is the auditors coming in and fine-tuning your revenue reduction percentage and looking for an opportunity to reduce your revenue reduction percentage in order to recover some of the wage subsidy that you may have claimed. Questions?
Perfect. Thank you, David. Can you hear me all right?
I can now.
Excellent. So we have had some questions come in, and I don't know if you'll still address it, but I'll ask them while we have them here. So one, would you please clarify, maybe flesh out the claiming of the first 10% wage subsidy program? We have seen some conflicting notes from CRA on how to handle that 10% wage subsidy program. So I guess any context on that would be helpful.
So I'm going to give you pardon me to clarify. I'm going to do my best on it, but this is where I turn and say the joy of being in a large organization like this. It's our PAS team, our People Advisory Service, has been dealing with a lot of the actual calculation issues. But with respect to the temporary wage subsidy program, with CEWS 2.0, they phased it out. They didn't extend the temporary wage subsidy program. But to the extent that and I think the issue is, to the extent that you claimed it or are entitled to it. And I believe the issue is, to the extent that you are entitled to the temporary wage subsidy, the 10% wage subsidy, you have to reduce your CEWS claim for the period to which you're entitled to that amount. Because what the government has said is that if you haven't claimed that temporary wage subsidy, the 10%, when you've filed your payroll remittances for the particular period, ultimately, when we do the reconciliation of your payroll remittances in January and February of next year, they will take into account that 10% wage subsidy. So you can't double dip. You can't get the concept here is you can't claim in respect to the same wages and remuneration, both CEWS and the 10% wage subsidy. I hope that's of assistance and answers the question.
I think so. Another question we have: if companies want to speak with you specifically, David, would you be available? And just so everyone knows, we're going to be distributing the presentation here, and I believe your contact information is in it. And I assume you'd be open to having further discussions on specific.
I will, although I'm going to make a request, and this is going to seem so strange for an outside advisor to say this and the rest of it, but I'm going to ask that you reach out to Krista or your contact at EY, and we can schedule a time to discuss. The reason being is that one of the things that happened, as I mentioned, I do tax litigation, and the tax court and provincial courts all came back, and they took everything that was scheduled for March to June, and they said, you either accept the date that we take or you're not going to get a date until 2023. And so I have literally 7 weeks of periods constantly coming up. So I might be a little bit of, here's the key. I might be a bit of a challenge to get a hold of, but it's mid-October, I'll free up completely.
Excellent. Well, we'll make sure that Krista has contact information, who's been our main contact and is just excellent. We'll make sure that folks have it. Excellent. Thank you. Another question here: if a company identifies an error in a submission, I guess in CEWS 1.0, what's your best recommendation on how to address this? Any advice on that?
So my recommendation: they have allowed you to amend the CEWS return, your CEWS filings if you've made an error in it. Now, here's my caution: the legislation technically says that once you filed your application, the number you put in your application is the maximum amount you're entitled to. So my concern there is that if you've put in your application, you said, I'm entitled to, for the particular month, $1.5 million. And then you've redone the calculation, you said, oh no, I'm entitled to 1.7. The concern is it's worth asking and trying to do the amendment, but technically the legislation would say that you wouldn't be entitled to go back and claim the additional amount. If it's the other way around, you claimed 1.7 and you're actually only entitled to 1.5, they have they have opened up the system to say repay CEWS or to amend your claim. And my recommendation would be to unless there's other reasons, and I would be cautious about it, but I would recommend going back and paying the excess amount, so that you're not in a circumstance where you're accruing interest and penalties associated with the actual amount itself. If it's a question of what we've been dealing a lot with is payroll has been an issue in terms of here's the other part. If you hadn't been claiming this because you hadn't been in the program and you're now trying to do your payroll calculations, do not, with my respect level for everyone who works in payroll on our people advisory side's gone through the roof, because if you think payroll is simple, payroll is not simple. One of the biggest challenges is this subsidy is based on remuneration that's attributable to the particular 28 days. It's not based on when you paid it. And rarely do your pay periods line up with what matches. And so you're doing this allocation back to the relevant pay period. And there's an added complexity that comes along with that, and it takes some time. If you've made that type of error, part of the thing that I've been saying is before you go and make amendments and the rest of it, let's look at how the numbers will work out for the balance of the program, because perhaps you can put your claims in and then ask for money to be transferred around in order to minimize your interest and penalties associated with it.
Perfect. Excellent advice. Thank you. Another question here. Does a company's participation in Canada's work sharing program, that's where I believe you take the EI and you're able to do some work sharing to allow people to keep continue employment. So does the participation preclude the employer's ability to claim CEWS wage subsidy for those employees engaged in that work sharing program? So the interaction between CEWS and work sharing.
It doesn't, but the amount that you're entitled to in CEWS gets reduced by the amount that was attributed to the employer that the employee received under the work share program. So much like the temporary wage subsidy, the 10% reduces your CEWS claim. Equally, the amount that the employee receives under the work share program reduces your CEWS claim, which that's easy to say. And then let's just put it this way. It's the employee who receives the amount. You're claiming CEWS. You need the information from your employee in order to get in order to determine how much you should be reducing it. And we've run into some challenges there as well.
Okay, excellent. Thank you. Another question here. Can I claim different levels at different operational facilities? For example, if we have a location in Ontario and work is down by 80%, but in Alberta or British Columbia, it's only down by 35%, and the Ontario is only, a smaller portion of the BC or Alberta. Do you have to add them all together, or can you apply on the different operational facilities depending on the levels? Sorry, that's a little bit complicated, but.
No, I totally get it. And we get this a lot in terms of, CEWS is claimed at the eligible entity level, which means you're going to claim it based on the legal entity or the partnership is how it's determined. So if you've got a single legal entity with 5 divisions, with one division down and the other division up and the rest of it, you have to look at the whole organization across all of the divisions. Whereas if, as opposed to having divisions, you have separate subsidiaries or separate corporations, you can look at each of those corporations separately. And then there's flexibility provided by 125.7 sub 4 and the elections that are available there that allow you to do, there's 2 things you're allowed to do. The first one is if you've got a whole group of subsidiaries that are affiliated, and we've gone through a lot of work in determining affiliated rules under the Income Tax Act, if you've got an affiliated group, that group can elect to take all of the qualifying revenue and bring it together and just use that single number as determined as if you're doing a consolidated financial statement for all of those entities as a group. So that you can bring them together in that fashion but recognize you can't cherry pick. It has to be your entire affiliated group has to consolidate. The other option is if it is your normal accounting practice to do consolidated financial statements, 125.7 sub 4 paragraph A of the Act allows you to file on a non-consolidated basis, determine your qualifying revenue on an entity by eligible entity basis. So that's designed, if you think, that was very much designed for CEWS 1.0, so that if your consolidated group was only down 25%, but you had, this entity ran a restaurant and it was completely decimated because of CEWS, that entity was still entitled to claim on its own with respect to its employees. So there's some flexibility. And what this is really highlighting is the amount of modeling that you'll have to do to take a look and say, well, what's my best strategy for claiming this under the program?
Perfect. That was helpful. Thank you. And then maybe just a more of a general question for you, David. We've seen aerospace obviously being impacted greatly with respect to COVID-19 and probably more dramatically than some of the other industries. Do you see if you take a look at your crystal ball here, looking into the future, do you see any carve-outs for industries that have been hit harder, any interest from the government on either extension into 2021 or making the criteria a little bit different, something we've been advocating for?
So I would have turned, if you'd asked me to look into my crystal ball when they announced this change, I went, yeah, they're going to extend it. They saved up one more period to give one more Christmas gift just before the holiday season started. But then they would stop the program, because I can tell you that my impression is that the Department of Finance would prefer not to continue extending all of these programs. I'm going to say that I don't have a crystal ball now, because the current government prorogued Parliament. We're going back for a throne speech. We have a new leader of the opposition, and I think despite the fact that everyone has, at least for the initial part of this program, politics got set aside. Everyone did the mature thing and said, we need to support Canadians and we got to stop playing politics and the rest of it. I look at what's happening in Ottawa right now in terms of the proroguing of Parliament, the throne speech that's coming out, and I suspect that in terms of, I'll turn and say I think that there's going to be some uncertainty in terms of what the current Liberal government proposes to come forward as a proposed measures for what they envision for a future of Canada, and so that they can contrast that with what the new leader of the opposition, Mr. O'Toole, and the Conservative Party will present. And I think we're back into playing some politics on it. So I think we're into a period of uncertainty. So being able to turn and say they're going to provide specific support, for example, for the airline industry, for the and I pause and go, from a practical perspective, I think they're going to have to do something. I fear for your industry, just in terms of I look in from just pure travel until the US border opens again. Things aren't coming back very quickly at all. And I think the government recognizes that they have to provide some support, but I think it will no longer be a broad-based program like this. I think it will be very tailored and specific to specific industries. The other ones being tourism and the performing arts and conferences and the hospitality sector as well. I think they'll recognize that they have to take some steps along those lines. But remember, I'm a tax lawyer by day. I'm not a political pundit, but that's what I'm predicting. That's my armchair.
That was a great moonlight. It's, as our members will know, that's something that we've been pushing very strongly. That sector-specific approach to industries such as ours that have been hit, harder than some of the other ones. And when we look at what's going on internationally, our competitor nations are doing that too. So it's something that we're very much continuing to push on to this federal government. We have one other question here, and then maybe I'll turn it back to you, David. It's actually in the chat there, so you can probably see it also. If we have selected the cash basis accounting method to compare our revenues with the average collections from the previous period, during this reference period, we happen to receive multiple outstanding payments from clients, boosting the regular cash inflows for reasons out of the company's control. Could it pose any problem with CRA, and I guess specifically with the CEWS?
Yeah, so just, and I can't see the chat just the way my screen is up, if I've understood the question properly. So the first thing to note is if you've elected to use cash, that's
Correct.
the one election that you're stuck using for the entire program. So you're stuck with it throughout.
So if you have that extra inflow of cash that you weren't expecting outside of your control, how does that impact?
Then unfortunately the cash methods, and the cash method is probably the one that has been the most challenging for all of my advisories, our financial accounting advisory people, because they go, there's no such thing as cash, the cash method. And there is the cash method. It is just simply defined under section 28 sub 1 of the Income Tax Act. And unfortunately, what you're going to have to look at is that extra inflow of cash, which may have thrown you offside on it that you weren't expecting. It comes down to a question of, can you describe that as extraordinary income or an extraordinary item? Can you describe it as an amount being on account of capital? Or can it be viewed as a reduction of expense as opposed to, so we've run into circumstances and questions with respect to, we had one client who unexpectedly received their 2019 SR&ED claim immediately at the end of April. And the question was, we weren't expecting that. Do we have to include that in determining our qualifying revenue? And so you can see with that unfortunately the answer to the question is, it's going to depend on the facts with respect to the particular payment. So if you suddenly received unexpected payments which could be classified as extraordinary items, then perhaps you can exclude it. But I would just caution, where we've seen probably the most challenging is dealing specifically with the cash methodology. So why don't I just take us through, and this shouldn't take long, to take through the balance of the program and some of the technical amendments.
And maybe David, we'll probably just end it there
Okay.
on the question and answer portion, so you can continue. And then if there's anything else, if people can just keep feeding to me, and then I'll connect them. So back over to you. Thank you.
Okay, perfect. Thank you. So technical amendments, and this has been an interesting one for me because I remember back in March and April when the program was announced and we were working through the legislation, I think of some of the advice I was giving then, and then they changed the program, and then they further changed the program, and then they further changed the program. So here are some of the things that they have fixed. So the first one was the concept of eligible employer. Initially, an eligible employer excluded anyone who was tax exempt. So in other words, it meant that to the extent that you might be in partnership with Aboriginal corporations or Indigenous-owned corporations and band entities, didn't qualify. They've expanded the definition of eligible entity to include Indigenous-owned subsidiaries of an Indigenous corporation and Indigenous corporations themselves. A broader impact, that's not what I intended to do. The broader impact is that also means who was excluded. If you were in partnership with an Indigenous corporation, your partnership was excluded from being an eligible entity under the old program. That's now fixed, or that's now changed, that if you are in partnership with an Indigenous entity or Indigenous corporation, your partnership will now qualify. Similarly, with respect to tax exempts. So if you have a partnership that you're a partner in it, but you also have a pension fund that is one of the investors in the partnership. As long as, because pension funds are tax exempt under 149 of the Income Tax Act, under the old rule it was tax exempt don't qualify. If the partnership includes a tax exempt, then I'm sorry, the partnership doesn't qualify. What they've done is they've said, and that wasn't fair in terms of what if that pension fund only owned 10% of the partnership or had it only a 10% interest in. Well, that wasn't fair. So what they've done is they've said, as long as the tax exempt throughout the qualifying period in question, their interest is 50% or less in the partnership, then in that circumstance, it'll be an eligible entity. They also, well-registered charities qualified for the program, registered amateur athletic associations and registered journalism organizations didn't qualify. They fixed that, so amateur athletics associations now qualify. And then they corrected, remember, public institutions were not allowed to qualify for the program. and that included schools and colleges. What they realized is that also impacted private schools and colleges. So flight schools, art schools, driving schools, language schools that are private now qualify for the program as well. The next thing that they've come in and fixed was that under the old rule, the employer who's the employer who is applying for the CEWS had to have a payroll account on March 15th, 2020. Now, there are paymaster arrangements in this country, which corporate groups install, where essentially the legal relationship, you'll have a central entity, call it a central services organization, that will employ everyone. Or pardon me, they will be paid through that central paymaster within your corporate group. But the reality is with your 5 operating subsidiaries, the employees might be an employee of any, the true hiring and firing and contractual relationship is with those 5, one of those 5 subsidiaries. The problem with that is that in terms of the paymaster company wouldn't technically have qualified for CEWS under the initial definition. What they've done now is they've come in and they've said, if you've got a paymaster arrangement in place, and if you can think, like, the practical reason why people have this in place is because, well, I have an employee who's in our Eastern Canada company, and I want to transfer them to our BC company. Well, technically, what you would normally have to do is you'd have to terminate them in the Atlantic company and hire them in the BC company, and you'd have to issue records of employment and everything else. And so people install these paymaster arrangements to say everyone's just going to be treated as if they're employed, and all the source deductions are going to be done by the paymaster up top. They amended the legislation to recognize those structures. What I'll say is a challenge with it is what the government's done, at least what CRA and what's currently displayed on its website, is it says that if you've got a paymaster arrangement in place, in my example, the Atlantic Canadian and the BC entities and the 5 operating subsidiaries didn't actually have payroll accounts, you can contact the CRA, inform them that you had this paymaster arrangement. They will issue a payroll number to each of those 5 entities. And then here's the rub, so that the 5 entities are entitled to claim CEWS based on their payroll. But the rub is that they've turned and said, oh, and all future remittances now must be made in those entities through payroll source deductions. And so I can tell you that that's become a problem because it effectively takes what the paymaster arrangement is supposed to achieve and dismantles it completely, because you just want to have a central paymaster to handling all of the payroll source deductions and the rest. So we're waiting for clarification from the CRA on that point. We've raised that with them a couple of weeks back, and I know that industry is raising it as well. Amalgamations and purchases of a business are the next thing that they dealt with. If you think about it, under the legislation, it used to be, well, you're comparing March of 2019 to March of 2020. Well, if you had Company A and Company B in March of 2019, and on December 31st of 2019, they amalgamated to become Company AB, your 2020 revenue is the combination of the two, and you would be looking back to compare to just the revenue of one of the entities or the other entity in 2019. What they've done is they have addressed that potential for amalgamations and said, you can take the 2 predecessor companies, combine their qualifying revenue in 2019 to do an apples to apples comparison. Similarly, if in 2019, you're operating, I'll do it as a mill or a paper mill just to put it in perspective. If you've got your company had a paper mill, and on December 31st of 2019, you went out and you bought your competition and you acquired 3 additional mills through an asset purchase agreement. Now you've got those 3 mills in your qualifying revenue in 2020, you're likely not going to qualify. What they've done is they've said, well, if you acquired all or substantially all of the assets of a business that's carried on in Canada, you're entitled to, if the vendor is no longer around, you can unilaterally make the decision to pick up the 2019 qualifying revenue of the revenue associated with the business assets to determine your qualifying revenue. If the vendor is still around, so you only acquired a division, then you have to elect with the vendor of the business of the assets or the business assets in order to be able to determine your 2019 qualifying revenue by taking that business income into it. Eligible employee, just a couple of additional technical amendments. As I mentioned, eligible employee for periods 5 through 9, there's no 14-day requirement. That's been eliminated. The concept of baseline remuneration has been eliminated for all but non-arm length employees for the balance of the program. And then the tax litigator is pleased with this, which is they've actually implemented a process where you can receive a notice of determination of your CEWS, which means that now that you've got the notice of determination, if you disagree with the amount, this goes back to the question about amendments and the rest of it, if you've received the notice of determination, that gives you the ability to file a notice of objection and ultimately appeal rights to the tax court to the extent that there are any particular issues associated with it. So that's in a nutshell I realize it's taken about an hour to go through and give you a general overview of CEWS 2.0 and those technical amendments. I'm hoping that it is of assistance. I always turn and say, when you boil it down and think of it conceptually, you know, it's not that much of a challenge. And then I get on the calls with our clients to go through the modeling that they've done, and you realize the complexity. It's easy to describe as a concept. There, like everything, there's devil in the details, and that's in terms of the, as I say, from an accounting standpoint, the work that the things that questions of proportional versus equity accounting of partnerships. Do you have to pick up the partner? If you're a member of the partnership, do you have to pick up their revenue in determining your qualifying revenue? Quarter end adjustments, hedging transactions, interest dividends. There's a number of issues that go into determining your qualifying revenue, what should be in, what shouldn't be in. And my recommendation, particularly if you are claiming under the program, for CEWS 2.0 is, even though you've done it, I'll guarantee you'll do a ton of work pulling it together, have someone come in and review it just to ensure that you've addressed the numbers. Because if you think about it, now a couple of percentage points off, you're going, well, that won't be terribly significant. But if you've got 1,000 employees and you've claimed that wrong amount, then you're going to be in a fight. I look at it and go, there's going to be on the audits. That's what CRA is going to go after. It's no longer going to be an all or nothing test. It's going to be, we think your percentage is 5% lower because of this, and exclude those amounts. And getting solid on that number now, when you're fresh and you're looking at it, is going to be a lot easier than filing the claim and then trying 2 or 3 years from now with an auditor to remember what we were all doing right now. And my test for every client who says, oh, we're not too concerned about it, is tell me what you were doing 3 years ago in September. And that's the challenge. Equally on the payroll side, my suggestion would be consider either, if you think it's going to be easy, start doing it now. The deadline for filing is January 31st. That may seem like it's a far way off, but I would start doing the calculations now, because the payroll calculations, to do them right, take much longer than you anticipate. And what I'm concerned about is people are going to wait before actually saying, well, I want to see how the whole program models out and then I'll figure it out. What I can tell, what you now know with CEWS 2.0, as long as your organization is still experiencing a reduction in revenue, you know you're going to qualify. So you might as well start getting your payroll numbers and allocating your payroll to the proper periods and figuring out which codes are included and excluded now, so that you're not in a mad rush in holiday time in December and coming back in January knowing that you've got a hard deadline to ensure that all the claims are in and complete and true and valid by January 31st. So let me turn back for any additional questions that might have come in.
Excellent. Well, thanks, David. I haven't seen any additional questions come in, so maybe we'll just leave it there, but we will make sure that the presentation is handed out and that Krista's contact information is sent around. We very much wanted to thank you, David, for your time and your expertise and your ability to put this into some plain language for our members. Again, we got some very good feedback from your original one, so we're very pleased that you could take some time out to be with us today. So thank you, and thank you, Krista, and thank you, Ernst Young, for being such a great partner for us here at AIAC throughout the COVID-19 pandemic. I will mention to members, if there is questions, please either put them through myself or you'll see something coming out from Lynn. Also, as we just continue to go through the COVID-19 pandemic and the relaunch and the recovery, if there's other webinars of interest that people will be looking for or companies would find beneficial, please let me know and we're happy to help set them up. Krista, maybe, I don't know if you had any closing words. If not, then I think we'll close off here and we'll make sure that this is also up on the website so that that other folks can listen that didn't have a chance. So again, thank you, Krista. Thank you, David. We very much appreciate it.
Thanks very much.
Have a good day, everyone.
Thanks for the time.